So, ladies and gentlemen, and esteemed members and guests of the Alliance for Green Commercial Banks, I'm Carlos Serrano, head of the Secretariat of the Alliance for Green Commercial Bank. Let me share a little bit what is the Alliance. The Alliance is a global initiative convened by the International Finance Corporation, IFC, which is the largest development bank supporting the private sector in emerging markets. The Alliance has partnered with the Hong Kong Monetary Authority as a founder and our first regional anchor for Asia, demonstrating commitment to promoting green and responsible investment. The Alliance is a membership platform that was created with a vision to transform the commercial banking industry and the financial sector overall to support a greener, more sustainable future. Today is my great pleasure to welcome you all to this webinar, an event that marks yet another stride in our collective journey towards fostering responsible investment practices across Asia. As we gather here virtually, let us acknowledge the significance of our mission, which is to catalyze the financial sector's role in the transition towards a sustainable and green economy. Asia stands at a critical juncture with its dynamic economies and rapidly growing markets. However, this growth comes with a responsibility, the responsibility to invest in a manner that ensures the well-being of our planet and its people. Responsible investment is no longer a choice, but a necessity, as we face the pressing challenges of climate change, resource depletion, and social inequality. The Alliance for Green Commercial Bank has been at the forefront of this transformative movement, advocating for green financing and supporting our members in integrating environmental, social, and governance (ESG) considerations into their core business strategy. Our commitment to responsible investment is not just about mitigating risk, it's about seizing the opportunities that come with the transformation to a greener economy. Today's webinar is designed to provide you with insights, tools, and best practices to navigate the evolving landscape of responsible investment in Asia. Our esteemed speakers will share their expertise on how to align investment portfolio with sustainable objectives and how to measure and manage the impact of this investment. Without further ado, thank you very much. Welcome you to this webinar, and I pass the screen to you back, Susana. Thank you very much.
Thank you, Carlos. Thank you all for joining this webinar on the topic of driving climate action, responsible investment in Asia. I'm Susanna Wong, Senior Manager of the Market Outreach Division at the HKMA. I will be the moderator of today's webinar. Today, we're delighted to have with us our important partners, Cheung Leong, Chief Strategy Officer at HKMA, Emily Woodland, Head of Sustainable and Transition Solutions APAC, BlackRock, and Ronald Wu, Head of Greater China ESG and Sustainability Research, UBS, to deep dive into responsible investing. Without further ado, let's begin with the first presenter, Cheung Leong, to set the scene and showcase the exchange fund's journey of responsible investment. Over to you, Cheung Leong.
Well, let me start by sharing with all of us sort of how Hong Kong is dealing with it. So we are approaching this issue in a coordinated fashion. So in Hong Kong, the whole sort of green and sustainable finance, there is a cross-agency steering group co-chaired by HKMA and SFC. The members include all the important bureaus from the government side, but also the exchange and some other finance institutions as well. So a lot of these efforts by different members in the community are sort of coordinated through this mechanism. When it comes to HKMA, of course, we are a central bank. In the meantime, we have the responsibility of reserve management. So through, I think, different roles, we also play slightly differently, in these respective roles. So today, I'd like to focus a bit more on the exchange fund itself. So of course, if you look around the reserve managers around the world, I think it still holds that safety, liquidity, and long-term preservation of capital. These are all very, very important. Similarly, in Hong Kong, these are written into sort of the mandate of the Hong Kong Exchange Fund. So it's legally, we are responsible for the fund as such. But fair to say, we have set responsible investment, ESG, as one of our guiding principles as well. So today, whatever investment opportunities we look at, we always have a sustainability lens to look through it as one of the more important elements. We started our journey actually relatively early. So as the chart said, 2016, we adopted the principle of responsible ownership. But in fact, even before that, in 2015, we already started to invest in green bonds and etc. So I think it kind of, I think it's very much representative of our journey, is that, we will try different products first, and then we try to then learn from those experiences, and then we try to scale it up a little bit more. So I won't go through all the steps, although they're all very important, but I would say we are also one of the early central bank, or maybe even still the very limited few central banks who have explicitly committed to a 2050 carbon net zero target. So far we are progressing reasonably well. And like I said, we have put sustainability ESG lens into all of our investment considerations. The approach we use, I think these are quite familiar. I think in the sector, these are, we learn also from the leading players, and we hope to be also inspiring other players or regulators or like-minded reserve management in terms of integration, collaboration, and active ownership. I think carbon net zero is one approach, but more and more, I think the sector is also talking about transition. It is particularly relevant in Asia. So how do we, encourage and motivate and accelerate some of the brown companies, economies to become greener and greener, in which we think active ownership will become more and more important. So we're also spending quite a bit of time in the last year or so, starting to build our own framework, working with our external managers. How do we, as an owner, set an example and how we help accelerate this progress as well. So before we come to the experience, just want to show or share with you the overall progress since we started our journey in 2016. Now, if we compare our own portfolio on the public equity side anyway, the weighted average carbon intensity from 2017, where we set the baseline, to 2022, our latest year with data, we have actually come down about 46%. So this is, in a way, exceeded our own expectations. But we also understand, initially these could potentially be more so the lower hanging fruits. And going forward, it will be, becoming more and more demanding in terms of how we engage, our managers, how we then also participate in a broader sense of carbon reduction in the industry. So not just by, pick and choose, but really by active ownership. The way we conduct ESG investment or sustainable investment is very diverse. So we practically, we've been able to find products and partners in practically all the asset classes we participate in. So whether it's fixed income or public equities or private equities, we've been all able to find good partners to work with. In many cases, we also see that you can do good and do well in the meantime. So of course, there are certain cases whereby we take a conscious choice to work with strategic partners, whereby we potentially would take a long-term capital preservation kind of approach, but not necessarily market benchmark return kind of approach. But also in many other instances, we've been able to find market comparable returns opportunities. I think it's quite, it's not so hard to understand and appreciate, as we can see some industry players, when they're more aware of climate risk, they generally can weather through some more challenges than others. So they are a little bit more resilient. So many times our managers told us, these are good winners to choose. In some other cases, I think you see, particularly I think in private equity opportunities, you see companies actually really jump on some of the mitigations and solutions opportunities that in a way also give us very, very good market comparable returns in that sense. Now, last but not least, we continue to see challenges, of course. I think reporting standards, they continue, need to evolve to set a clearer and clearer guidance to all of us. Data integrity, data availability, I think these continue to be, I think particularly in emerging markets in Asia, these continue to need to improve. Also in terms of overall infrastructure and capacity building. But I think we always, in our team anyway, we always believe that perfection cannot be the obstacle for progress. So we want to proactively participate in this journey, and we also want to be innovative by sometimes taking certain risk. So I think I'll stop here. Thank you.
Right. Thank you, Zhongliang. Let's welcome Emily to share her insights on opportunities in the low carbon transition. Over to you, Emily.
Right. Thank you, everyone. It's a great pleasure to be here and be part of this webinar. So today I'm delighted to just walk through how BlackRock approaches sustainable and transition investing and walk through some of the exciting opportunities that we're seeing in this part of the world. Let me just take a step back and start with our approach as an asset manager. Obviously, Lum went through asset owner approach, but ours is a little bit different. Next slide, please. As a fiduciary, our role is to really understand and manage investment risks and opportunities, to anticipate client needs, and to work with them to achieve their long-term investment goals. So in that context, our approach to sustainable and transition investing is really the same as all investing, and it's really driven by three core principles. So first of all, we start with the client. Our clients choose their sustainability objectives, their investment objectives, and they look to BlackRock to meet those needs. Now, objectives in sustainability can vary very significantly. So we offer a wide range of choice across index, active, and whole portfolio solutions. The second pillar is really around performance. So our job is to seek the best risk-adjusted financial returns within the bounds of the mandates that clients give to us. Now, where we have the discretion to do so, our base case is to manage all material risks and opportunities that could impact portfolio outcomes. And that includes those related to sustainability. And then third thing is everything that we do is grounded in robust research, data, and analytics. So we're researching major structural trends shaping the economy and markets and asset prices. Now, the transition to a low carbon economy is one trend that we invest a lot of time researching in because we see it having implications on macroeconomic trends, company financial prospects, and therefore, of course, our clients' portfolios. So we assess the investment implications of the low carbon transition through three main driving forces on the next slide. The first one of those is technology. So innovation is really bringing down the costs of the transition rapidly relative to incumbent technologies. The second thing is around consumer and investor preferences. Now, these technological advancements of the kind of scale that we're seeing contributes to a large shift in consumer and investor preferences, and that impacts demand for sustainable products, both in the real economy, but also in financial markets. And then the third thing is this structural shift is accelerated further by policies. Now, this is things like the US IRA, the EU Green Deal, or Japan's Green Transformation Policy. We're seeing tax incentives, rebates, grants for low carbon energy infrastructure and technology, all spurring capital investment and manufacturing capacity on a systemic level. And this is especially crucial now that geopolitical developments have caused this demand for clean energy to be amplified by a focus on energy security. Governments need to manage the risks of the huge energy demand and supply shocks and price inflation that we've witnessed since the Russian invasion of Ukraine. Now, we don't see this transition as being a linear process. These three drivers are interplaying in a very complex way, and it creates material investment opportunities and risks, and these are factors that long-term investors can't ignore. So according to our research, $4 trillion of capital investment is going to be needed in the energy system every year globally by 2050. That's double the current number. Now, in terms of what we're seeing investors doing on the next slide, we're seeing many global investors grow increasingly interested in tapping that $4 trillion investment opportunity. Last year, we surveyed 200 institutional investors from over 15 countries about transition investing. We asked questions like, what's its level of importance to you? What are your expected changes to allocations? What do you need from asset managers? And the most significant finding was that 56% indicated they would increase their allocation to transition strategies in the next 1 to 3 years. Here in Asia, it was around half of the respondents. Now, 98% of the global respondents had some sort of climate objective set for their portfolio. The most common of those was a net zero emission by 2050, just like Long said about HKMA. Now, some of us have committed to things like a certain year-on-year emission reduction target or a target allocation to climate solutions. But what clients are really looking for with all of that is solutions and strategies that can help them implement those targets across their whole portfolio. And that's where we're really here to help. So what do we mean by transition investing in general? So on the next slide, we show our definition of transition investing. And this is investing with a focus on preparing for, being aligned to, benefiting from, or contributing to the transition to a low carbon economy. Let me just go through what each of those means. So when I talk about preparing for, I mean investing in assets that are better positioned for the transition, like those who are improving or leading on mitigating emissions within their peer group on a relative basis. When we talk about being aligned to, we mean investing in portfolios or assets that are on a decarbonisation pathway that's aligned to an industry-accepted low-carbon scenario. So, for example, something like a Paris-aligned benchmark. And then benefiting from, this is investing in assets that may not traditionally have been considered as green or sustainable, but they provide the key inputs that are necessary for decarbonisation. And they're going to benefit from the macro trends that are offered by the transition. This might be things like lithium or copper miners, for example. And then lastly, contributing to is investing in solutions needed to mitigate emissions in the real world. And this is the real sort of commonly understood green investments like renewables or battery storage or carbon capture, for example. So what does this mean for where we see opportunities in terms of the risk return spectrum and capital stack? I'm going to spend a little bit of time on the next slide because we do see opportunities across the whole corporate life cycle. And that's everything from cash burning early stage companies to more mature later stage corporates to publicly listed companies. Now, infrastructure in particular is critical for the low carbon transition. And that's from lower risk return infrastructure debt to the higher octane core and core plus infrastructure equity. So the same investor survey that I quoted earlier, over 30% of those respondents intended to increase their allocations to transition infrastructure over the next 1 to 3 years. And the investment needs and opportunities span the whole energy value chain. That's from power generation to storage to transmission and ultimately even consumption. And many of those investment opportunities are happening right here in Asia. This region contributes to more than half of global emissions. Our proprietary research estimates that low carbon energy sources will comprise the majority of the region's energy demand by 2050. If Asia doesn't get the transition right, the world doesn't. So I'm going to walk you through just a couple of examples of where we've invested in Asia's transition via those core infrastructure equity buckets that you see in the upper and middle part of this chart. So first example, in February 2024, we partnered with Detrolic, a Malaysian operator that builds commercial and industrial utility scale solar assets. Now that partnership is going to increase its targeted total capacity to 5 gigawatts of solar projects across Malaysia, Bangladesh, Indonesia, and the Philippines. Second example, in September 2023, we announced a partnership with Chao Energy. That's a renewable energy operator in Thailand. And that's going to help Chao Energy develop and build out a gigawatt of domestic greenfield commercial industrial solar capacity. That's forecast to reduce 1 million tons of carbon emissions over its lifetime and to contribute to Thailand's overall goal to achieve 30% renewable capacity by 2037. And lastly, in May 2023, we partnered with Cleantech, a renewable energy developer building large-scale solar assets in the Philippines. And that's going to support their target to develop a gigawatt of solar capacity by 2026. That'll support 125,000 households across the country and save 1.3 million metric tons of greenhouse gas emissions over its lifetime. And beyond these, we've invested in renewable infrastructure in markets such as Australia, New Zealand, India, Korea, and Taiwan over recent years. I'm just going to pivot now to the bottom left-hand section of this chart. There's also various ways of investing in the transition through debt instruments, and that's beyond just green bonds, which is where investors often start this journey. But if we look at infrastructure debt, where we see investment opportunities generally anchored by long-term contracts, stable regulated return frameworks, and strong asset level collateral. Now, in particular, we see growing interest from insurers across the world for transition-focused infrastructure debt, Less than 2 months ago, we announced a partnership with the UK's Insurance Development Forum. That's a consortium of leading insurers, and that partnership is going to develop a blueprint to facilitate investment in climate-resilient infrastructure debt in emerging economies. So that blueprint is going to mobilize investment from the insurance sector and other institutional investors and partner alongside catalytic capital providers to create a new innovative blended finance investment structure to help drive investment into a very critically underserved segment of the global infrastructure market. And then you can also think about private debt. That's a common financing tool for small and mid-cap companies. And that comprises 9 out of every 10 businesses worldwide. So that's a huge opportunity set right there. Now, this chart just refers to the private markets opportunities, and publicly listed companies are crucial to the transition as well because they own most of today's customers, supply chains, infrastructure, and engineering expertise. And investors can access those opportunities through the core of their portfolio via active investments, where we might be picking companies that benefit from transition-related tailwinds, or index investing approaches, where we might be tilting into, for example, allocations to low-carbon indices. So investors have no shortage of opportunities to put capital to work in the transition. The scale of investment needed for the transition is tremendous, and it really does span across the whole capital stack and across all stages of the corporate life cycle. So I'm going to stop there for now. I look forward to exchanging further thoughts in the panel discussion in a moment, but I'll pass back to you, Susanna. Thanks so much.
Thank you, Emily. Next, we have Ronald to share his insights on incorporating climate-related factors in investment research. The floor is yours, Ronald.
Really pleased to listen to the last 2 speakers. I think they really lay out very well from a high level some of the developing landscapes and the variety of investment opportunities and instruments that are out there in terms of responsible investment. So what I'll do is to build on what they say and to look into perhaps some of the more real world examples and go into a little bit more details into how this is done oftentimes in investment research or in portfolio constructions. So this screen that I'm sharing is a snapshot on carbon trading. So I think a lot of audience members, I'm sure, would be familiar with carbon trading. Essentially, it's well, in the context, this is shown in China. In the context of China, power companies basically buying or selling allowances in order to meet certain quota that or limits on emissions that they have every year. So this is the first example that I want to go through. So if you look at the left-hand side, this is just a table of a hypothetical table of companies and how the carbon costs factor into their company's financials and operations, right? So for example, if a company has an allowance of 100 and but it has emitted, let's say 120, then it would essentially need to buy 20 or make up that 20 from the market through the trading. So I chose this example because it's actually one of the more intuitive examples and it's easy to understand. But essentially, the cost of this would go into the model or your financial statements at either as a cost or maybe as a tax in some cases, right? So it's quite intuitive, and the reason why I picked it is that oftentimes what we see, especially in markets where there is already fairly established regulations and rules around carbon, around environmental, these are become fairly standardized items, especially when the quantity of it, when the impact of it can be easily quantified. So in this case, this is it, right? The price of the carbon price, how much emissions you have, and if you just multiply that, if you look at the bottom right corner, that's your carbon cost, right? Obviously, to compare across different companies to understand how that affects their earnings, which company may be better positioned versus others, then that puts a little bit more complexity and due diligence needed to perform that analysis. But in instances where these impact can be quantified and are rule-based based on fairly transparent rules, that's fairly straightforward. But what we see also, I would say, in the field or in the approaches to integration of different ESG factors is that inevitably, even with the development of further rules and guidances, there will be a variety. And part of that variety is because each sector is different, each market is different, each geography is different, such that different companies, different sectors, different locations, they would have ESG factors that would matter more, let's say from a financial sense, than others. So here's an example that I'm showing for Japan real estate, and on the left and on the right hand side is Korean utilities. So if you focus on climate, I circled them. You notice that the climate factors that affect these sectors are quite different. For Japan, it's extreme. Japan real estate, especially, is extreme weather patterns. So whether there are typhoons that would affect, let's say the asset value of the property, maybe even some liability if it creates damages, and obviously if there's a reduction requirement to reduce the energy intensity or the carbon intensity, then that becomes cost for the landlords, right? So again, these are not really rocket science concept, but what I do want to show is that they are quite different if you look from the right hand side versus the Korean utilities. So the Korean utilities, there is an overall net zero target for the whole economy to decarbonize, and Korean utilities is at the forefront of it, right? So that means that, first of all, in the middle, you have a very direct and explicit carbon pricing that these Korean utilities, they have to abide to, but also in a more amorphous way, that these companies, they are under pressure either from the shareholders or even from the government to transition, to have more renewable energy in their portfolio. So that is some of the outcomes of the policies drivers that we see. What that means is that for these different sectors, the impact, which is represented by the y-axis here, and then the likelihood, which is on the x-axis, can be quite different. So that is where some of the integration, some of the analysis comes into play. Different asset managers, different research analysts, they would have different views, but essentially, at the end of the day, a more successful integration process would actually revert all of these back to financially common metrics. It can be growth, it can be ASP, it can be margin, it can be earnings. Essentially, what you try to do is to revert back to all these things. This is just another example. So on this idea. So this is just another approach of how people dissect or look at climate, right? So there are different angles that you can look at climate. You have policy, you have technology, you have adaptation, physical events, how impactful they are, how likely they are. It's oftentimes, a very subjective exercise. So this, again, I just want to show the variety that's there. And at the end of the day, one of the key question is, well, does this improve my risk-adjusted return? And I think the answer is I would say it's still undetermined, or it really depends on the approach that you take, right? But I would say that the general view in the market right now is that looking at these ESG factors, looking at these climate factors, it generally gives you more perspective to integrate, to enhance, or to an opportunity for you to analyze more useful decision, useful information. So from that angle, I think the industry has that consensus. I do want to show one example where, where in a study that we did see that a low carbon portfolio, maybe contrary to some perceived notion, that actually outperformed. So what we did here, this is a global portfolio set, and what we did is that we did a sector neutral, market neutral exercise. So for example, an autos company in Japan would be compared to another autos company in Japan. Likewise, a power company in Brazil would be compared to another power company in Brazil. We split them up based on their carbon intensity. So we put them in 2 buckets. Simply put, high intensity bucket, low intensity bucket. And what we saw was that the portfolio that has low carbon intensity has, quite significantly outperformed on the global portfolio scale. Even though I don't have the slides here, that the performance does diverge a little bit based on the regions that you have. So regional portfolios, their performances seems to be a little bit more mixed in that sense. So I think that goes into showing that my point that there is a lot of diversity across different regions. And the final thing that I want to mention is that while looking forward, I think climate change will still be, and it already is, but perhaps even more important aspect of investment. And certainly one of the key aspect of it to climate, but also other ESG, is the measurement and the reporting of it. So what this graph that I'm showing is how I look at the ISSB or the pending IFRS sustainability standard. And I think what I try to capture here in the dark green is that these are items that are already normally reflected in your regular financial statements, so your P&L, your income, your asset, et cetera, et cetera. But what I think how this industry is transforming through this standard is that what you see is that some of the light green area that are currently not captured, not always captured, or not captured to sufficient details in the traditional financial statements, they are being included. And from ISSB or IFRS, standpoint, this is what they call enterprise value. Some of it, just to give an example, would be, for example, considerations that are a little bit further out in the time horizon. So not necessarily meeting, today's, strictly speaking, accounting standard. But then under this revised disclosure standard, they would be in scope because ultimately these are things that would affect the enterprise value of the investment, and therefore they will be captured. So I think this just shows that, earlier I showed the analysis that we did, the variety of it. A lot of it is already quite sophisticated, but I think there is still quite a long way to go with greater disclosures, with disclosures that better link ESG factors with financials. I think there will be a greater opportunity for investment or investors to find value by looking in further details these different ESG factors.
Thank you, Ronald. Thank you all for sharing your insightful perspectives from different angles. In the next 25 minutes, we're delighted to have Cheng Liang, Emily, and Ronald join us for a panel discussion and Q&A session. The first question is for Cheng Liang. What role does the HKMA perform to support responsible investment?
I think, again, HKMA play multiple roles in the society. So we are a central bank, we regulate the banks. So on that side, I think we also participate in building the taxonomy for Hong Kong and coordinating with the banks how best to pursue it. So my response to your question, perhaps, again, more so on the exchange fund side. So how we invest as a responsible asset owner. How do we use the market clouds, if you will, to help also support and help facilitate, accelerate the intensity of investment in the sustainable investment side. So I think for that, like I said, we started very early, back in 2015. We already started to invest in green bonds. We also participate and collaborate with major international organizations So like us joining as a signatory of PRI. I think also, set example, putting up targets, setting net zero targets, and then also putting through investment guidelines in our investment process. So I think these are how we try to be a responsible investor, asset owner, and really put them into the day-to-day work.
Right. Thank you, Chung Leong. Sustainable finance is still a developing field. We have the following question for each one of you. Let's begin with Emily. As an early adopter of investment, have you faced any difficulties and how did you resolve them?
Great question. I'll try and keep this. That's a big question, but I'll keep this as quick as I can. So look, let me start by, I wouldn't call this a difficulty per se, but it is worth starting with the reality that we have to face as an asset manager, because clients can have very, very different sustainability or transition related goals, and those goals evolve over time. And, it starts with some investors might want to screen out certain activities to align with their values. Some might be interested in alpha opportunities of investing in certain themes. Some might want real world impact. And many have no sustainability objectives at all. So it really isn't possible to use one blanket approach for all investors with different investment appetites and constraints. So that comes back to where I started my presentation earlier, which is the importance of choice. And that's across the full breadth of asset classes, geographies, investment styles, sustainability approaches. This is no small task, even for an organization like ourselves. So that's the first thing I would say that we had to navigate. The second thing actually goes back to where Ronald finished his presentation, actually, which is really around data, because research, data, and analytics forms the bedrock of our investment decisions as well as our product innovation. And that really has to start with company disclosures, because it allows us to evaluate how a company is considering sustainability-related risks and opportunities in its business, and how we track progress against sort of stated goals. And so it's an important input in how we construct sustainable investment strategies. And right now, qualitative and quantitative company disclosures around things like emissions, green revenues, green capex, risk management practices, these are still not quite sufficient for the most part. And that can hamper capital allocation decisions as well as the development of new and innovative strategies. And nowhere is that more acute and more pronounced than here in Asia and other emerging markets. But that's also where the big opportunity is, because as I said earlier, that's going to be the majority of global emissions. So we're quite encouraged by what we're seeing evolve in the regulatory space in terms of, potentially the adoption of ISSB guidelines, which we're seeing being taken up in multiple jurisdictions across the region. And that should eventually get us to a point where we can better leverage these disclosures from companies to construct more robust sustainable investing strategies.
Thank you, Emily. Next, we have Roland.
Sure. So I think my answer would be quite similar to Emily's, or I'm seconding what she said, especially on the data front. I think in the development or construction of different products, oftentimes, especially for those that has a global mandate where you want to have a standardized approach across your global portfolio, oftentimes that investment universe may be constrained because you don't have enough disclosures that aligns with your approach in different markets. So in that sense, the investable universe that often asset managers can choose from is constrained because of that. And in terms of solutions, I think it'll be a gradual process. So I am also encouraged by the fact that a lot of these jurisdictions, regulators are pushing very hard to improve that transparency and, ideally in a standardized manner. But for now, I think it's quite ad hoc approach in the sense that oftentimes, first of all, there needs to be a debate around localizations versus global, right? So you want to take into account your local context, but how do you make sure that, maybe in principles, in approach, that you're still aligned with your global approach or mandate? you might need to directly engage with the companies or other sources to fill some of the information gap. So I think that's a very important, or at least right now, approach that is available to help with that. The other, I would say, is that education and awareness is also a challenge for a lot of the investors. I would say, especially retail investors, they are still much more intuitively linked, or they understand thematic, investment a lot better than integration, right? It would take maybe half an hour for someone to explain ESG integration, and they still not may not get, hey, why do you do it? So in that sense, I think, it's a gradual process where if investors, or if they are, the society as a whole is become more aware of the reason, the rationales behind why we do responsible investment, I think that would also be quite helpful.
Right. Thank you, Ronald. Over to you, Jonah.
Yeah, I agree with what the other two speakers just shared. It will be a gradual process. We're in here, for the long game. But I'm also quite optimistic, because I think if you look at sort of 10 years ago where things were compared to today, it's a very fast growing space. All of the above, both in terms of investment opportunities, in terms of professionals that are participating actively in the space, in terms of people's awareness, in terms of regulators' awareness and actions they can provide. Yeah, I think to me there is always a regulatory flooring, if you will. So the regulation provides the very minimal standard we all have to adhere to. But investors or key market players in the capital market, I think we really are there to provide an aspirational ceiling, if you will. Sometimes it might not be sort of fully, just sort of protected by some regulations to make it very easy to defend. But I think we have a role. Of course, I would also say that within that role, we also need to recognize our limitations, and our stakeholders also need to understand and appreciate the limitations. After all, a lot of these actual changes will happen at the company's level, at the real economy level. So as investors or as owners, through deployment of capital, we try to encourage certain behaviors so that we will have a more sustainable future. But sometimes it's hard to just say, a direct causal relationship. But I think as aggregate, when we all come together, then the capital market has a fairly big influence also on the real economy.
Right. Thank you, Jonah. And thank you all for your insights. Now let's turn to Emily and Ronald. Emily, how do you balance the potential trade-off between short-term financial returns and long-term sustainability goals in your investment decisions?
I think Ronald touched on some of this in his presentation, but look, I'm just going to go over a point I made in my presentation earlier, because our base case starting point is where we have discretion. It is our role as a fiduciary to manage material risks and opportunities that can impact portfolios, and that includes any factors related to sustainability that are materially relevant to investment outcomes. And that is because we believe that provides clients with better risk-adjusted returns over the long term. But taking a step back, any investment strategy can see short-term volatility around a long-term trend. Investment strategies with explicit sustainability objectives are no exception to that. So let me unpack kind of the short-term and the long-term thesis here. So when we talk about short-term volatility in sustainable investment strategies, I'm going to use the example of the geopolitical events and the supply chain bottlenecks that we saw in 2022, which disrupted the world's supply of oil and gas. That caused massive energy price inflation. And so that did have short-term implications on some sustainability strategies that were underweight traditional energy companies. But actually, over the medium to long term, it's actually reinforced the case to speed up clean energy investment in order to shore up energy security needs. So that's one example of where kind of the short-term volatility doesn't necessarily change the long-term case for sustainability. Now, similarly, where you do have strong real economy tailwinds, this always needs to be looked at in the context of what is always already priced into markets. So valuations on any theme often can and do overshoot or undershoot in the short term, even when kind of real world transitions continue apace. And so that can lead to tactical opportunities. And you know, in our world, for example, we've seen that happen with electric vehicles. So yes, you do have to be mindful of valuations and tactical opportunities, but we obviously have to constantly test our conviction in whether our long-term thesis in any strategy still holds true. And the low carbon transition, it's not a linear process. That interplay between technology, between consumer preferences, government policy, that could unfold at different speeds across different regions and sectors. That's going to continue to reshape economies and sectors for decades to come. That structural shift is very well underway already in the real world. So that long-term thesis is still very, very much intact. Now, the other thing I'm just going to say quickly about performance of sustainable strategies is the transition is by its very nature a forward-looking topic. So we have to make sure when we're talking about performance of sustainable strategies that we're comparing apples with apples. I've already said there's a lot of different ways to approach sustainability strategies that use different tools, and therefore they can have different implications for performance. So for example, strategies that lean on backward-looking data or blunt tools like whole of sector exclusions, that can sometimes lead to short-term volatility in performance when market rotation happens between sectors. So this is why it's really critical to bring it back to where I started, which is you really have to start by understanding what is a client's objectives and what are the tools you're going to use to meet those objectives. And you cannot necessarily compare all of those with each other.
Right. Thank you, Emily. Let's turn to Ronald.
Sure. Well, the easy answer for me would be to just say what Emily just said, right? But I think maybe just to add my 2 cents to it, I think first of all, I would debate the notion that there necessarily is a trade-off. Maybe just another way of what Emily put it, but if you just even look at, I think whether short-term or long-term, there are quite a few, green or responsible investment opportunities that are quite, attractive. So, for example, if you look at the green lending in China, it's a very fastly growing field. We expect it to reach 70 trillion RMB past 2030. But even if you look at the return profile of them, right? The ROA, ROE, they are, at least when we look back historically, superior to some of the standard corporate loans. So I think that's one example where having these products or loans that are aligned with taxonomies, that are aligned with certain sustainability goals, do not suffer a trade-off. So I think that's the first thing that I want to emphasize. Then I think in terms of balancing it, I think this goes very specific into specific individual investments or investment managers' mandate and their decisions and their strategy. But I would say that the first thing that I think is important is to have more transparency and understanding of your portfolio. So I imagine that a lot of the audience in today's webinar, they may be in some of the earlier phases in the journey. So I think the first thing that would be useful to do is to understand, even fairly standard things like your carbon footprint, right? Without that, it's pretty hard to map out that roadmap on how you transition, how you allocate your different assets or your portfolio. So I think I would start with that. And then from there, review how a transition, a multi-year transition would impact your allocation, your return, your tracking error, all those things. So I think that's probably the process that I've seen some of the leading players do. And I think that's probably a pretty prudent process to start understanding or reviewing whether in your case, whether there is any trade-off between the two.
Right. Thanks, Ronald. As we approach the concluding segment of today's panel discussion, we would like to invite each of you to share your view on the final question for the panel. Let's begin with Cheng Liang, Ronald, and then Emily. Cheng Liang, where do you think your organization stands in terms of responsible investment?
Right. Yeah, I think as one of the central banks reserve managers, I think we're quite reasonably advanced and very committed to this goal. So our whole organization, so beyond even the exchange fund, has committed to a carbon net zero target by 2050. And I think our leadership are very much committed to it. They are looking for every single opportunities to even accelerate or exceed the design path, which I think the organization is also in general very, very supportive and aligned to that vision. So when it comes to exchange fund investment, like I said before, we participate actively in international organizations. We try to set also examples by investing in different products and also by looking aggressively and proactively at the further opportunities available that could really help balance our overall portfolio in terms of also when it comes to sustainable investment. So I think to us, we feel like we started reasonably early. We have a pretty good standing so far, and we continue to look for opportunities to expand and hopefully help to accelerate this trend in sustainable investment.
Right, thank you. And Ronald?
Maybe I'll go ahead on this one. So at UBS, I think we certainly recognize the importance of an orderly transition to low carbon economy, and that has been our focus. We want to be a global leader in sustainability. What we've done is that we've partnered with our clients to help them mobilize capital to make this happen. So on one hand, we want to be a financial provider of choice to mobilize the capital needed to achieve goals such as the UN SDGs. Right now, what we recognize is that there's not enough private capital to make that happen. So we want to be part of that. We will also continue to work with and invest in companies that we believe has a clear decarbonization plan that are basically in the process of transitioning their business. So in short, on the financing side, right now in our implementation, we are abiding to a very stringent sustainability climate risk policy framework that instruct or inform our transactions. And on the investment side, one thing that we emphasize is active engagement with companies. We know that through our decades of experience, the positive influence that we have can be quite tangible and would be critical to achieving our goals. So I think these are the main approach, and what we aspire to in terms of targets is to have a total AUM that will be aligned to net zero by 2030. On our AM side, that target is 20%. Obviously, there's a lot more that we can and will do. But for now, these are how we're positioning ourselves to become or to support responsible investments.
Right, thank you, Ronald. And Emily, your thoughts?
Sure. So, our approach to this space is very much, coming from our position as a fiduciary. Our role is to really understand and manage investment risk and to anticipate and stay in front of client needs and work with them to achieve their long-term investment goals. So really where we're investing our efforts is to empower our clients to be able to make the right long-term decisions for them by providing them the right research and data and analytics that help them do that, as well as to be able to actually then implement that across their portfolio with the portfolio building blocks and choices that we give them. We've obviously been on a journey in this area ourselves since about 2020. Our sustainable platform now stands at $889 billion. In 2020, that number was $199 billion. So we've come a long way in this space ourselves. It became very clear to us that clients were looking for help not only on how to allocate to that kind of green and sustainable end of the spectrum, but also how to think about that middle ground of the transition and how we get from brown to green in the more carbon intensive parts of the portfolio. And clients were really looking for help with that. So we, we're the first among our peers to really define what is transition investing in the middle of last year. And that now stands at $160 billion of assets just focused specifically on the transition to a low carbon economy. And that's where we continue to build out our efforts to support clients in that journey, both from a research perspective as well as a product perspective, and particularly in private markets and infrastructure. So yeah, still a lot of opportunity to go in this space, and clients kind of hopefully coming to us as the go-to partner for that.
Mm-hmm. Thank you, Emily. With that, we have come to the end of our panel discussion. Now let's open the floor to Q&A. We have received some questions from the audience, and I will read them out one by one. The first question goes to Cheng Leong. What is the outlook for responsible investment in Asia?
That's a great question. I think first of all, for Asia, it's in high demand of sustainable investment. As we all know, the transition of the economy requires a large amount of capital. Some estimate a few $1 trillion a year, some estimate over 60 trillion in the next 20, 30 years. So from a use of capital perspective, I think Asia has a lot of potential. Because I think one of the speakers mentioned this, if we don't solve the Asian challenge, we don't solve the world challenge. So I think from that sense, it's very, very important for Asia to be able to have access to those capitals. Now, of course, if you look at, I think from the capital side, one of the things I observe is that the PRI membership. Of course, today, I think Europeans are still the largest group in the PRI signatories. But if you look at the recent 2 years development, the Asian participants, the number of growth is the highest. So I think even investors who sit in Asia, I think they're paying more and more attention to the space. Of course, I think in Asia, we still need to overcome the challenge of data integrity disclosure and other things to make investment more user-friendly. But I think these are solvable problems, in short, medium term. So I'm very optimistic in that sense. Now for HKMA ourselves, we have also a couple of dedicated Asian transition funds that are in play. So we will continue to look for opportunities in Asia as well. Thank you.
Thank you, Leong. The second question is for Emily and Ronald. Emily, how do you foresee the development of measurement and taxonomy in Asia over the next 5 years? And what challenges may arise? What kind of support can help foster the sustainable finance ecosystem?
In general, I welcome what we're seeing in the regulatory space, which is, efforts to improve transparency, improve disclosures, help people wade through the alphabet soup, and really kind of introduce some standardization into the market to make it clearer for the end investor. So I think that's a really, really great development. But we do have multiple regulators across the region, and this is everything from Hong Kong, Singapore, Australia, Japan, Korea, that they're all setting guidelines or standards on sustainable and transition investing, company disclosures, asset manager obligations, corporate obligations. And so, all of those different members of the ecosystem need to manage these differing regulatory expectations on things like fund labeling and disclosures. So what's going to be really, really critical is the interoperability of these regulatory standards, so that we don't end up with a situation where it's really fragmented across the region, and then that becomes kind of counterproductive to scaling this across the region, because you can only operate in one given market. What kinds of support can help foster the ecosystem? I would say, because companies, investors are facing challenges and, in some cases, capacity constraints in complying with various regulations and setting these frameworks and standards, I think it's going to be really, really important for influential organizations like the IFC, like the HKMA, to continue building platforms and engagement channels like this webinar today, to help continue fostering knowledge exchange, to help us build capacity in the system, so that we can continue to meet these rapidly evolving and critical issues, because there is an undersupply of talent and knowledge in this area to be able to meet those ever growing and evolving needs at the moment.
Right. Thank you, Emily. Over to you, Ronald.
Great. I would agree with what Emily said about the interoperability, or basically avoidance of fragmentation across different markets. I think that's hugely important from an efficiency perspective and from a scaling perspective. But I would also add that in terms of the taxonomy, the taxonomy is just a document. It's a very good start, right? But it's just a document that needs to be operationalized. So in order to do that, especially for some of the players, banks and investors have relatively smaller capacity, they need help in the capacity building in terms of operationalizing it. So for example, just in terms of, let's say, a credit approval process, how do you actually apply that taxonomy? I think that's there's a gap in some areas. The capacity needs to be built up in order for it to be applied at scale. So I think that's the first thing. Second thing, I would say that in terms of taxonomy development, right now, I would say a big part of it is being applied in the fixed income, in the bond space, but the application to equity is arguably constrained, right? So I would say that if there is an expansion or supporting mechanisms to expand that. It's not an easy task for sure, but if the taxonomy can be enlarged to apply with greater relevance to equity, I think that would also be helpful. And then final thing is that, or final two things. One is that I think the taxonomy in many cases right now is focused on climate topics, but ESG, sustainability is a lot bigger than climate. So I think there should be an expansion of other important topics outside of climate. And then I would say the final thing is that there are certain types of instruments or investments that may need incentives to develop. So let's say biodiversity or assets that are not easily revenue generating. In those cases, I think incentives, whether public or from other sources, could help develop or demonstrate some of these products. So I think these are developments or support that would help foster that ecosystem.
Thank you, Ronald. As we bring our panel discussion to a close, thank you all to the panelists and everyone who joined us today. We now invite Carlos to share his closing remarks. Carlos.
Well, thank you very much. Thank you, Susanna. Thank you, colleagues. It has been an extremely interesting webinar, and there's no doubt that we have a challenge ahead of us here from the Alliance, working all together with leading institutions like yourself, and of course our partner, the Hong Kong Monetary Authority. We hope that we can accelerate these responsible investments across Asia, which are very much needed. And with this, thank you very much. I really enjoy listening from you, and I'm sure that all the participants have also done. See you on the next webinar. Back to you, Susanna, if you want to say something.
Thank you. Thank you all. We've come to the close of this webinar. Thank you, everyone, for joining. Bye.